First off, this video is not implying that Ethereum won't be some type of a useful network in the future, and it certainly doesn't intend to undermine the efforts of Ethereum developers today. In fact, Ethereum has very respectable use cases right now, such as stablecoins as well as venture capital fundraising. This video intends to do one thing: examine the long-term value proposition of Ethereum's native digital asset, Ether. And while Ethereum was created in 2015, the height of its mania begins in 2017.
Markets coming off of the highs of the morning. The Nasdaq's on pace for the worst day since about August 17th. The Dow and the S&P did set some new record highs this morning. And meantime, Bitcoin crossing 11,000 for the first time just a few hours after topping 10,000.
But this is a mania, is it not?
Yes,
it is.
We're just getting started, and this financial speculation is fueling the development of infrastructure. We've invested in over 110 companies that are building infrastructure around digital currencies, and all of those companies are raising money. They're capitalizing themselves through ICOs or token offerings, and they're using that money to build all of the infrastructure that's going to fuel this new financial system.
Said, well, it's probably more like rat poison squared.
It's just terrific, but Bitcoin clearly under pressure. Those who buy Bitcoin-related items, this is not what you want.
In 2017, the emergence of hundreds or even thousands of ICOs was a phenomenon that brought billions of dollars in mass media attention to the cryptocurrency space. Ethereum's role in the cryptocurrency industry in 2017 was extremely important for the growth and popularity of the space because it served as a platform where virtually any developer or entrepreneur could issue their own ICO token and raise funds with essentially zero barrier to entry. Although there were numerous scams which emerged from this, the attention and glimpse into blockchain technology's potential was enough to attract thousands of new developers and investors into the space. Despite bringing mass media attention to the cryptocurrency space, Ethereum's tradable asset is actually a hindrance to the efficacy of the network as a whole. If the tradable utility token becomes extremely valuable in a monetary sense, it in effect destroys the utility aspect of the network. So, to fully understand this concept, let's form a clearer understanding of Ethereum's value proposition and what it was designed to do in the first place. So, Ethereum is a platform where any developer can create a decentralized app, and each time an action or a computation is performed in a decentralized app, a gas fee is required which is denominated in Ethereum for that action to be performed. So for example, Augur is a decentralized application built on Ethereum which serves as a prediction market. So each time a user places a bid on the Augur prediction market, they need to pay a gas fee which is denominated in Ethereum. So as you can imagine, as the price of Ethereum increases, applications built on the platform become more expensive to use, and more friction is created as a result. Popular apps have clogged the Ethereum network at certain times as a result of this hyperactivity. Andreas Antonopoulos, leading Bitcoin educator and author of Mastering Ethereum, elaborated on this flaw in a 2018 interview with Peter McCormick.
The tradable asset, in fact, is counterproductive in the use of Ethereum. One of the things that Ethereum maximalists don't get, to switch this a tiny bit, is that if your tradable utility token becomes valuable in a monetary sense, it destroys the utility aspect, meaning that you can't use it to run an efficient network where fees arbitrage between different uses of software that's running on the network because it becomes too expensive to fucking run and the friction is too high. So, the other aspect of this is a successful Ether platform that creates a successful Ether investment destroys the software platform. And that's what people don't get.
But then how do you have an incentive? What's the incentive to run the system?
You need an incentive, but that incentive is a unit of account for computation. It is not a store of value. And that is a very different function.
Like Andreas said, the token still needs to have some type of value in order to create an incentive structure for miners to secure the network, as well as prevent against denial of service attacks and other vulnerabilities. However, this incentive structure of the Ethereum token is better suited to act as a unit of account rather than an investment that increases over time. This is what Vitalik Buterin and Joseph Lubin of the Consensus organization aren't telling you, and it's why the Ethereum core developers have yet to implement a hard cap on the total supply of Ethereum. The Ethereum Foundation and Joe Lubin's organization Consensus need investors in order to continue operations and development. So ultimately, they have no interest in explaining how an increasing Ethereum price is actually a double-edged sword to any long-term Ethereum investor. While facts are rational, markets are not, and so Ethereum could increase in the next bull market cycle. There's always a possibility that this video doesn't age well. Even so, investors have to use the existing information at hand in order to evaluate the future of current systems. As of now, just remember, if your Ethereum investment increases and succeeds another 10x, it may be wise to take profit because the efficiency of the network in its current form will most likely be compromised. It's impossible to know how technologies will evolve and be used in the future, but above all, this video attempts to outline a humble prediction by questioning the current conceptualization of Ethereum as a store of value and as a method of accruing wealth.